So thanks, Mike, very much for inviting me to participate in this, what looks like an extremely interesting day. Before I begin, I just would say, please note that the views I express here today are my own and not those of the IMF's executive board or the IMF's management. But that said, my role here today, as requested, is to provide some perspective on how the issues of the day that Mike referred to, complexity, competition, uncertainty, affect lower income countries. And I think the answer to that can be summed up quite succinctly as really pretty differently from developed countries. So why are lower income countries different? We can start just with what you see on the screen here, the fact that corporate income tax revenue is relatively considerably more important to the low income countries than it is to the advanced countries. And to top that off, they actually have less government revenue, tax revenue in general. So on the right, you see the average tax revenues as a percentage of GDP for high income, lower, middle, and low income countries. And I will say note that these two charts exclude very resource rich countries for which we have a definition depending on how much of their GDP is dependent on resources. And the reason for excluding them is because income from that source is really taxed in quite different ways in different countries. So if you're looking at corporate income tax, it distorts the results quite a bit. But on the left is the principal point. You see the blue line is the high income countries, the black and the red dotted lines are the lower, middle, and low income countries. And if you look over at the right-hand side, which is 2014, or 2015 is actually the farthest side, and that is the latest data that we have. And it shows that while corporate income tax produces maybe 6% overall in the advanced countries of total tax revenue, it produces more like 10 or 11% in the low and lower middle income countries. So maybe even more interestingly, why are they different? Why are they different? Well, generally, to state the obvious, they have much lower administrative capacity. And that means that these countries struggle to implement the existing international framework. They struggle quite a lot, actually. And the capacity that they have is not at all well matched to the capacity of a well-advised multinational enterprise. And BEPS, as we've just been discussing, however important and well-intentioned it is, it's definitely not a simplification, certainly for the low-income countries. So simplification is pretty important. More important for the low-income countries. Looking at the last bullet, actually, the low-income countries are under very strong, and I would say even stronger pressures to compete through the direct grant of tax incentives and tax exemptions than the higher-income countries. And that is brought out in the fact that, as Georgia was mentioning, the OECD, our other colleagues at the bank and the UN, we do a lot of work on issues that the G20 have brought up or requested, and one of the things that they requested a couple of years ago is that we do a report on what was actually called effective and efficient use of tax incentives in low-income countries. And the reason for that is because it's so important. And perhaps most key for what follows and the rest of what I'm going to talk about is the first bullet, actually. Most developing countries, and by that I don't mean necessarily Brazil and India, but I mean the low and lower middle income, the low income, less developed developing countries, are essentially source countries. What does that mean? It means that the current international architecture was actually developed among more advanced countries where sometimes they were source, sometimes they were residents. When they're trading with each other, when these countries are trading and investing with low-income countries, that just isn't true. These countries are source countries. And so the current system just isn't very balanced for those countries. Source countries, in theory, I suppose, in theory have the first claim on business income, if you look at the current architecture. But to a great extent, that claim is given up intentionally, sometimes through entering into treaties, and especially through, for the developing countries, these tax incentive grants. But importantly, some of it's given up unintentionally, and quite a lot of it is given up unintentionally through tax avoidance and planning, which these countries just can't compete with. As Bob said, I thought pretty adroitly, there's no natural law that says that sets out the jurisdiction to tax. This is something that mankind made up, and it made it up without the developing countries on board. So as a practical matter, the current architecture just doesn't work very well for the low-income countries. Here's an example. In one not wholly atypical developing country that I'm not going to name, 45% of corporate income tax revenue comes from fewer than 30 companies, and this is outside the natural resources sector. The vast majority of those are subsidiaries of multinational enterprises. The statutory tax rate is 30%. If you look at the average effective tax rate for the 5 sectors other than the resources sector that are the most important recipients of foreign direct investment, at best, for one of those sectors, the average effective tax rate is 9%, and that ranges down to 3%. And about 50% of the inbound FDI in that country comes through treaties with the Netherlands and Mauritius. Which brings us to my next point, which is treaties and developing countries. There are now about 3,000, as you all know, there are about 3,000 bilateral international tax treaties in the world today. You see from the graph above that the treaties that non-OECD countries have entered into and have kind of exploded in number in the last 25 years. It's especially the case that even more recently, the treaties with very low-income developing countries have exploded in number. There's a great deal of pressure on developing countries to sign double tax treaties as a form of investment incentive. It's exactly the same kind of pressure that these countries get to give a tax holiday. MNEs and sometimes the partner countries themselves produce this pressure. Multinational enterprises will say, look, we can invest in you or we can invest in the country next door, and we'll invest in you if you produce a tax treaty with X, not even necessarily that country, and we'll invest through that. It's generally a mistake on the part of these countries to think that this works necessarily or that it's important. There's a lot of econometric evidence that ties treaties, that basically shows that trying to tie treaties causally to foreign direct investment, the evidence is quite weak. But certainly as an anecdotal matter, this is what developing countries think. For source countries, the treaties necessarily, of course, result in giving up some claim to taxation through reduced withholding and effects of permanent establishment in some cases, but also through, in many cases, preventing the operation of provisions that the countries have well-advisedly put into domestic law to protect their source base, but the treaties then vitiate the application of those. And of course, as you also well know, the protection of source taxation for a country, in this case a developing country, with respect to a well-advised investor is essentially only as good as the provisions that are in the worst of the treaties that it's entered, the least favorable treaty that it's entered. Witness my last example. So there are some things that low-income countries should do with respect to their treaties. They should include or add to provisions to withhold on management fees, service fees. They should impose capital gains taxation on offshore taxation of national assets. And they should probably include a limitation on benefits provision, anti-abuse provision in their treaties. And when I talk about offshore transfers of interest, many of you will be familiar with some of the famous relatively recent cases, huge cases, India, Uganda, Peru earlier, I think. So what do we mean by indirect transfers of interest? This is a huge concern for developing countries, for many developing countries. This is an issue that wasn't covered in the BEPS project, in part because it's really much more of a concern for low-income countries, and I think it just didn't come up when the questions that were to be addressed in the BEPS project were being considered. But again, this is another instance where the G20 on its own and listening to the OECD and the IMF was persuaded that it was important. And another report is about to be made public in the next week or so that the IMF and the OECD with the World Bank and the UN have done on this problem. What do we mean? There's a strong case in principle for taxing these transfers by the country where the assets are located, which in this chart is designated by A for assets. They're inside a country, they're inside a company in the location country in this picture, but the transfer of ownership of the rights to those assets takes place offshore, usually in a low tax jurisdiction, by selling shares. And there may be other companies leave between X and Y there. It could be actually sold by Y. So what did we determine? What did we decide upon in this report? Basically that, first of all, the application of capital gains tax by the source country, the country of location of assets A, should extend beyond a very narrow notion of immovable assets to include a bit more, somewhat more widely, at least any asset that's producing a location-specific rent like a natural resource. But there are other things that produce location-specific rents, obviously telecommunications licenses. These tend to be things, though not always, that are granted by the government in question. They're sometimes, in fact, the most valuable national assets that these countries have. There's been a sort of wide acceptance, if you look at the OECD and the UN model treaties, that the transfer of resources themselves should be exercised by the location country. And those treaties include provisions to that effect, Article 13.4 for the truly nerdy practitioners among us. But it's the case that that provision is only found in about 35% of all tax treaties, and it's actually less likely to be found in treaties between resource-rich developing countries and other countries, which is exactly where it should be found or is needed most. So in this respect, the Multilateral Convention on, let me get the exact title correct, the Multilateral Convention on Implementing Tax Treaty-Related Measures to Prevent Base Erosion and Profit Shifting, which is better known as the MLI, could have a positive impact by increasing the number of tax treaties that do include this article. That's one of the provisions of the MLI, and that's a very positive thing. However, as of the June 7th signing, unfortunately, it appears that about half of those countries that signed reserved on the article that would do that. So they won't accept this provision to be added to the treaties that are essentially effectively renegotiated by the MLI. What else? Moving on, we at the IMF have looked, as some of you know, we've looked at spillovers from essentially tax competition, the effects of one country's tax changes on other countries. And what we see is that there are sort of two kinds of spillovers. There's base spillovers, where one country A makes a change, and the tax base shifts. That doesn't necessarily mean that real activity shifts. And then there are strategic spillovers, which basically means that the other countries intentionally react by changing their own tax provisions, usually rates, which is sort of direct tax competition. So we did work with a sort of large panel data, but more macro flows data. And what this basically showed, I won't walk through all these little changes in the chart, but what it basically showed was that this is definitely not a zero-sum game. There's a collective loss of CIT revenue, as is not a big shock, since we have not only profit shifting but base erosion. But second, and most relevant for this today, the profit shifting effects are stronger for developing countries. We found double the effect on developing countries as with advanced countries. And that kind of effect, that topic or that conclusion have been subsequently found by others as well. Profit shifting is greater in low-income countries than in advanced countries. For example, there's actually a very interesting paper from a year or so ago by Johansson and co-authors, which used a very large, it's interesting because it used a big microdata panel at the corporate level. And they found that the effect was much stronger in developing countries than in advanced countries. So as Bob alluded to, this kind of competition becomes much worse if everybody has territorial tax systems, which of course the advanced world is basically shifting toward. Under worldwide with credit, of course, in the stylized model of worldwide with credit, 30 years ago, we would tell source countries, developing countries, well, you can tax up to the US rate, and there won't be any effect because they're going to wind up having to pay the 35% anyway, but it'll go to the US Treasury instead of you. But that isn't really the case anymore, and obviously, as is well known, the US doesn't really have worldwide taxation anyway. So what can we do to sum up? What can be done for low-income countries? Well, definitely, going through the slide, the top part of the slide, beware of treaties and their effect on you. Ensure that withholding taxes cover all the main forms of payment that are used for earnings stripping, which now includes management fees, and that's much less likely to be included in treaties. Use thin cap rules or interest stripping rules. In the latter case, it's basically what I mean is a restriction on the amount of interest that can be deducted in any year relative to EBITDA, earnings before interest, tax, and depreciation. And that tends to be more effective for low-income countries than thin cap rules. And especially important is not to restrict, if you're a developing country, it's really important not to restrict those restrictions to related party transactions, because it's so easy, as many of you know, you just structure around the related party transactions, and the developing country has a very hard time telling whether back-to-back loans, like back-to-back-to-back loans, where did they come from? And this may be a bit more controversial, but use safe harbors or more reliance on profit split and transfer pricing. That hasn't really been worked out in full yet, but Bob referred to APAs. We've referred to APAs in the context of setting greater certainty, but to a great extent, those are just beyond the capacity of developing countries to do in any effective way. The last two, maybe more speculatively, deny deductions on payments to low tax jurisdictions. Very hard for the developing countries to make that stick. And also there's, of course, the questions of how do you know where the ultimate benefit goes, or minimum taxation, conditional withholding on relative to whether those payments are made to jurisdictions, again, that are low tax jurisdictions. Unclear how well those would work or whether they could be done. More radical approaches, of course, many have suggested formula, especially among the CSOs, the NGOs have suggested, well, let's use formula apportionment. It would be much simpler, meaning, of course, allocating the multinational's consolidated profit on a formula basis, as in, as far as we know, all subnational corporate income taxes, not just in the US. We looked at that once, or more than once. And as is proposed in the EU for intra-EU corporate tax. In theory, this reduces the possibility for standard tax planning, but there are still quite a lot of complexities, I would say. And finally, most important for this particular talk, the chart comes from work we did a few years ago trying to estimate the impact of introducing formula apportionment on low-income countries. And we did it only with respect to US multinationals, because the only good data that we had was Bureau of Economic Affairs data, which only covers those because they're required to report these things. Anyway, we found using that data that the traditional three factors, alone, together, in combination, property, that is assets, destination-based sales, and labor cost, resulted in less corporate income tax that would be allocated to low-income countries, and the green bar is the low-income countries. I'm sorry, no, the red bar is the low-income countries. The green bars are conduit countries. Sales on an origin basis would help developing countries slightly relative to today. But of course, these formulas don't usually use sales on an origin basis. They would generally, it's spoken of as destination. Finally, if you actually use number of employees, again, not payroll, but numbers of employees, they'd get a big boost. But that's never actually been suggested as a possibility. And who knows what would happen to the employee numbers if this were introduced. Finally, maybe even more novel, the destination-based cash flow tax, which certainly has a lot of positives as a concept. It's a little tough on countries where all the significant earnings are from, say, resources or other location-specific rents. The Auerbach, Devereaux, et cetera, proposal that some of you are familiar with recognizes that you'd have to do something else with respect to those assets for countries that rely on those assets. You'd have to somehow allocate some, at least, of those location-specific rents to the source country. Almost all of the low-income countries already have a VAT on which they rely as much or more than they do on corporate income tax. That's just not an issue it's not an issue only for developing countries, but it's something you think about. This is another consumption tax. And if it were unilaterally adopted, it's clear that if everybody adopted it, it would mitigate some of the tax competition that we have now. If only one country, the country that shall not be named, adopted this, it would create more pressure for tax planning and tax competition. And finally, in the world of big data and better information, one can conceivably begin to think about just trying to tax the ultimate shareholders. The ultimate shareholders are way less mobile than the capital income tax base. Someday that may be feasible. Of course, however, if you did it now, if you could do it, it would actually radically reduce the tax base in the developing countries, because the shareholders of most, as you saw from the example I gave, most of the corporate income tax, or much of it in developing countries, is coming from multinationals, and those are not owned by people in the developing countries. So that would actually be a big negative with respect to the developing countries' tax bases. So thank you very much for thinking about the developing countries a bit today, and if anybody has a great idea about what to do to help them, that would be terrific. Thanks.